Are you investing for short-term or long-term gains? Do you want to save for retirement or pay for your child's college education? Once you know your goals, you can make investment decisions that align with them. Your risk tolerance is your willingness to accept risk in exchange for the potential for higher returns. Understanding your risk tolerance is crucial when choosing investments that are a good fit for you. If you're uncomfortable with high levels of risk, you may want to focus on investments that are more conservative. Diversification is a key strategy for managing risk in your investment portfolio. By spreading your investments across different asset classes, industries, and geographies, you can reduce the impact of any single investment on your overall portfolio. Conduct thorough research on the investment options you're considering. Look at the company's financials, management team, and competition. If you're investing in a mutual fund, examine its performance history, fees, and investment strategy. Taxes can significantly impact your investment returns. Consider the tax consequences of your investment choices and how they fit with your overall tax planning. Once you've made your investment decisions, it's important to regularly monitor your portfolio's performance. This will help you identify when to make changes or when to hold steady. Remember that investing is not a one-size-fits-all solution, and what works for one person may not work for another. It's important to take a personalized approach to investing based on your goals, risk tolerance, and financial situation. Seeking advice from a financial professional may also be helpful. Choosing a good stock for investment involves a lot of research and analysis. Here are some key factors to consider when evaluating a potential stock investment. 1. Look for companies with strong financials, good earnings growth, and a sustainable competitive advantage. Check the company's balance sheet, income statement, and cash flow statement for information on its financial health. 2. Evaluate the industry trends and prospects of the company. Look for companies operating in growing industries with favorable outlooks. 3. Assess the management team's experience, track record, and strategic vision for the company. A strong management team can be an important factor in the long-term success of a company. 4. Analyze the stock's valuation to determine if it is reasonably priced. Look at metrics such as price to earnings, P/E ratio, price to sales, P/S ratio, and price to book, P/B ratio to evaluate the stock's valuation. 5. Consider the company's dividend history and policy. If the company pays a dividend, assess the dividend yield and the potential for future dividend growth. 6. Identify the potential risks associated with the company and its industry. Consider factors such as regulatory changes, competition, economic trends, and geopolitical risks. 7. Evaluate the current market conditions and the potential impact on the company and its industry. Consider factors such as interest rates, inflation, and market volatility. Remember that investing in stocks involves risk, and no investment is guaranteed to be profitable. Conduct thorough research and analysis, and consider seeking the advice of a financial professional before making any investment decisions. Whether short-term or long-term investment is more profitable depends on various factors, such as market conditions, investment goals, and risk tolerance. Short-term investments typically have a horizon of 1 year or less, and they are often more speculative in nature. Short-term investors may try to capitalize on market trends, news events, or other short-term factors that can influence prices. The potential for high returns can be attractive, but short-term investments also come with a higher degree of risk and volatility. Long-term investments, on the other hand, typically have a horizon of several years or more. They can include stocks, bonds, real estate, and other assets that are expected to appreciate in value over time. Long-term investments often require more patience and discipline, but they can also provide more stable returns and lower volatility. Historically, long-term investments have generally delivered higher returns than short-term investments, but this is not always the case. Short-term investments can also be profitable under the right circumstances, such as during a bull market or when investing in high-growth sectors. In general, a balanced portfolio that includes a mix of short-term and long-term investments may be a more prudent approach for most investors. The specific balance between short-term and long-term investments will depend on individual investment goals, risk tolerance, and other factors. It's important to carefully consider these factors and seek the advice of a financial professional before making any investment decisions. Having a basic understanding of financial concepts is important before investing in the stock market. Here are some key financial concepts to understand before investing in stocks. 1. Financial statements provide information on a company's financial health, including its income statement, balance sheet, and cash flow statement. It's important to understand how to read and analyze financial statements in order to evaluate a company's performance and make informed investment decisions. 2. Understanding the different types of investments, such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs, can help you choose the right investments for your goals and risk tolerance. 3. Investing always involves a degree of risk, and it's important to understand the relationship between risk and return. Generally, higher risk investments have the potential for higher returns, but also carry a higher risk of loss. 4. Diversification involves spreading your investments across different asset classes, industries, and geographies to reduce risk. It's important to understand the benefits of diversification and how to achieve it in your investment portfolio. 5. Understanding market conditions and how they can impact your investments is important. Factors such as interest rates, inflation, and economic trends can all affect the performance of your investments. 6. Taxes can have a significant impact on investment returns. It's important to understand the tax implications of your investments and how to manage your taxes effectively. In addition to these financial concepts, it's also important to have a solid understanding of your own financial goals and risk tolerance. Investing in the stock market should be part of an overall financial plan, and it's important to consider your personal financial situation and goals before making any investment decisions. If you're new to investing or need help with financial planning, consider consulting with a financial professional.